Welcome to the webinar. Thanks so much for coming out. I'm looking forward to talking about how to buy your first 5 properties. So thanks for coming out. I know it's a nice sunny day outside, and you guys have decided to stay with me tonight, staying in and watching a webinar about investing in real estate. So kudos to you. All right, welcome to the presentation. I'll be talking about creating a game plan for yourself, making sure that you sort out your residence, making sure that you understand what a home equity line of credit product is and how that works. I'll be talking about buying properties number 2 and 3, how lenders qualify rental properties, how to purchase properties 4 and 5, and what gets a little bit more difficult when you're getting up to 4 and 5. Some of the things that the banks won't tell you, that wall that people often hit when they're trying to grow their portfolio. And I'll go through some quick tips and then a Q&A afterwards to go over a lot of details. So let's get into it, and let's talk a little bit about the very beginning stages. And that would be step 1, creating a plan. Really important to build a plan and understand where you want to take things, because the reality is that if a client comes to us and says, Kyle, I want to buy 1 property, that's a very different game plan than somebody that wants to buy 5 properties. Or 10 properties for that matter. Understanding where you want to go is really, really relevant and important in this case. And so one of the things that we always look at is trying to create a game plan that works for you today and gets you to where you want to be. The term or the phrase begin with the end in mind is super relevant here. Really important to come up with some kind of game plan that's going to help you build your real estate portfolio and grow it into whatever you want. If you want to buy 1 rental property as an example and that's it, we could probably focus more on rate and on loan amounts and things like that. If you're trying to grow a really large portfolio, if maybe we want to buy 10 properties, etc., then maybe we're going to actually be looking at buying in a company name instead of buying in personal names. There's all these other aspects and angles that start to become more relevant. And part of that game plan too is, how you structure things and how you grow the portfolio. It really depends on a number of different structures, but in general, usually people start off with a residence and then they buy their first rental and then they buy up to 5 rentals. And then in many cases, people start to get into, buying 5 plus, perhaps getting into the commercial side of things. And that portfolio and the game plan definitely changes. And the reality is it does get tougher and tougher and tougher as you buy more properties. And so we always want to make sure that the people go into this having a specific game plan in mind, knowing where they want to be and where they'd like to end up. And often that's an important question to ask yourself. So whenever you're getting pre-approved for a mortgage and getting this process moving, try to think about, what are you trying to do? What's your objective? Where do you want to be in 5 or 10 years? And then let's build a strategy and a game plan from that point backwards and figure out how many properties you're going to need in order to hit your objectives. So once you've got a bit of an idea of your game plan, the step 2 is to make sure that you are leaning and leveraging your residence properly. So if you don't own your own home, buying your own home is usually the first investment that you make. It's usually the best investment that you make. And that reason for that is that there's no capital gains on any appreciation on your residence. And so you're not paying tax on any of the appreciation on your own home. Whereas if you own rental properties, you do pay tax on that appreciation. And so in general, owning your own home is one of the first steps. And the reality is you have to pay to live somewhere anyway. So if you don't own your own home, then you're renting. And so you're paying somebody else's pocket. If you're in a situation where you're not sure if owning versus renting makes a lot of sense, I do have a rent versus own calculator that I'm happy to send over that would help you run the numbers and look at what your future net worth would be in 5 or 10 years if you own your own home instead of continuing to rent. And in many cases, even though home ownership is a little bit more expensive than renting, the net worth over time, because now you're paying down a mortgage and you have a home that's appreciating in value over time. In general, owning a home does usually make more financial sense long term. Now, if you already own your own home, then that's something that you would want to be looking at, making sure that you structure and get some kind of leverage. And the reason that I'm mentioning leverage is it's one of the most important things when looking at investing in real estate. And one of the reasons that a lot of people invest in real estate in the first place. Interestingly, 90% of millionaires made their first million in investing in real estate. And so a lot of people are just by owning their own home. In fact, a lot of people in Vancouver are millionaires simply because they bought their own home. And so looking at this and figuring out, okay, well, what is my game plan? Even just owning your own home is a great investment strategy from that perspective because of the appreciation aspect and because of the leverage aspect. And so if you look at why own your own home, it really comes down to that leverage aspect. It's one of the most important aspects of investing in real estate. And interestingly, when you're buying your own home, you can put as little as 5% down for your own home or for a second home. And 20% down is the minimum for rental properties. And so this is another reason that looking at buying a residence as opposed to a rental property for your first home is something that that will be very valuable to look at acquiring. So this is usually step number one, buying your own home. It's one of the reasons that that people usually start there first, is just the down payment aspect. And then, of course, you mentioned earlier the capital gains on the appreciation of a residence. That's another important aspect as well. I do want to give you an example of this appreciation and the leverage aspect because this is really relevant. And so if you bought a home that was $500,000, so you put 20% down and bought it as a rental, and the home value appreciates by $15,000, then and that's would be 3% on a $500,000 home. Your return on investment isn't just 3%, it's actually 15%. So let's go through this again. You buy a home for $500,000, you put $100,000 down. If the home value goes up by 3%, so that's 3% on the $500,000 value. So the home value goes up by $15,000. If you make your $15,000 on your $100,000 investment, you've actually made a 15% return. So the way the math works is that if you bought a home and put 1/5 of the property value down, 20%, then for every 1% of appreciation, your return on investment is actually 5%. So again, if you put 1/5 of the property value down, you're leveraging your money 5 to 1. This means for every 1% of appreciation, your return on investment is 5%. Okay. Now, if you do a personal residence and use the same example, so let's buy a place for $500,000 and now it's your residence. So you're putting just $25,000 down. And if the home value goes up by $15,000, your return on investment is 60%, which is kind of crazy. And this is not using a percentage of appreciation. This is just using a 3% annual appreciation. We have some people in really, really hot markets that bought, late 2020 and year over year going from late 2020 into 2021, there's a 30% annual appreciation on their property value. And those individuals would have made a 600% return on their capital if they put 5% down. I would never, ever tell somebody to buy real estate and you're going to make a 600% return on your capital. That's a bit crazy. But the reality is that the leverage aspect gives you the ability to make those kinds of returns. And that's something that you want to keep in mind is it's the leverage aspect that really affects the overall return on investment in buying real estate. Now, when you're looking at buying your first home, just keep in mind that there's a couple different directions that you can take with it. You can put 5% down, and that would mean that on a $500,000 purchase, you probably need about $125,000 of income, and you'd be looking at a maximum of a 25-year amortization. You can also put 20% down, and this would require a lower amount of income now for you to qualify. You probably needed more like $95,000 of income, and now you can get a 30-year amortization. And you can also get a home equity line of credit. So a home equity line of credit is a product that allows you to reborrow the principal that you've paid down on your mortgage, and you can reborrow that to actually invest in real estate or invest in something else. And so these are very different game plans. And sometimes we have clients that say, kind of want to buy as much property as possible and they don't have a lot of cash. Well, one of the strategies then is you can actually buy a residence with 5% down, and then you can buy another residence in the future with 5% down and turn your existing residence into a rental. Because it's not that you have to be a first-time home buyer to buy a property with 5% down. It just has to be that you're buying a personal residence and then you're able to buy with as little as 5% down. Now, on the flip side, of course, buying with 20% down means that you're not paying CMHC premiums. You're getting a 30-year amortization, so you're getting a lower payment because A, you're borrowing less money, and B, it's all on 30-year amortization. And then, of course, the home equity line of credit product is a very valuable tool. So to show you how that would work, if over time, if you had a property that was worth $500,000 you can get up to 80% of the property value available to you in credit. And so over time, if you had a $400,000 mortgage on a $500,000 property and you paid down the mortgage down to $225,000, that would mean that the line of credit limit would increase to $175,000, because both of these combined is $400,000 of total credit. Now, what it allows you to do, it allows you to not have to make the decision about, do I save up my money and invest it, or do I pay down my mortgage? Because what you actually get to do is you get to pay down your mortgage and pay it down aggressively. And by doing so, you're increasing the available credit you have on the line of credit. And then you can go in there and reborrow the money on the line of credit to then reborrow to invest. And whenever you borrow money to invest, the interest portion of the payments is tax deductible. So paying down that mortgage slowly starts to go over to the line of credit and increases the line of credit limit. And then what you're doing is you're reborrowing against that line of credit to invest. And whenever you borrow money to invest, the interest portion of the payments is tax deductible. So this is something that has been called the Smith maneuver. There's a good book that's been written by Robinson Smith that talks a lot about different strategies on how to save money in tax on your residence. I highly encourage you to get a copy of that book. I think I have about 10 in my office, and so if anybody would like a copy of that book, you can shoot me an email. Our email will be available at the end of the presentation, and be happy to put a copy in the mail and send it over to you in the event that you're interested in learning more about how to utilize the Smith maneuver. So something to look at there. Now, the key points on your first property, which is typically your home, it's really important to not overextend on the residence. Keep in mind that if you buy a really expensive residence, you won't allow yourself to have a lot of borrowing power to then go and buy another rental property in the future. And we'll talk a little bit about how lenders treat rental income in a while. We always recommend to take the longest amortization on all of your mortgages, even if you plan on paying it off faster. See, the lenders do typically allow you to make extra lump sums on your mortgage. Some are more flexible than others. But if you can make lump sums on your mortgage, you still pay it off more quickly, but the longer amortization keeps your payments low, and that's going to help with your future borrowing power. Sometimes we have clients where they have a really large payment on their personal residence, and even though they only owe a very small mortgage amount, because they have those really high payments, they actually don't qualify for a lot of money to buy a rental property. And so it's important to make sure that you keep your amortization low on all of your mortgages. Make sure too that you minimize or eliminate all of your personal debts. So often with those that already own a property, step number one for us is usually getting a mortgage and a line of credit on their home and making sure that you roll up any other debts that they have into the mortgage, because that's going to result in a lower monthly payment, and that will result in a better overall debt service ratio. Another thing that you could consider too is buying something that would be a good rental property in the future. So if you are, especially if you're looking at 5% down, then look at something that might be a good rental property in the future. And so you could buy something now that works for you today, and then eventually you can move out of it, buy a new residence for yourself, and then turn that existing one into a rental. And that is a very reasonable and viable strategy to building a real estate portfolio. The last thing I want to mention on this is rental suites. And so if you buy a house that has a basement suite in it, $1,000 a month in rent covers, well, right now it's probably more like $200,000 in the mortgage, but it'll cover, 200, sometimes in certain cases, up to $250,000 of your mortgage payments. And so a house with a basement suite really makes a big difference. And especially with the way that rents are going right now, there's a really big change and increase to rents. So the next step is purchasing properties 2 and 3. Okay. So how do you qualify? This is where it starts to become a little bit more relevant, understanding how lenders treat rental income. As the portfolio grows, this becomes more of a challenge, and people are usually shocked to find out how lenders treat rental income and how much is used to help you qualify. So the first one is what's called the 50% add to income method. So the lenders do is if there's $1,000 a month in rent, they would take 50% or $500, add it to your income, and they usually want about 40 or 44% of your income to be used towards all of your debts. And so really they're only using about $200 of that rental income to help you qualify. Now, under what's called an offset, which by the way, a lot of the lenders have changed policies about recently, And most lenders are no longer allowing rental offsets on the property that you're financing. They're only allowing it on the existing properties that you already own. So the government really wants, for whatever reason, you to be using an add to income method on any properties that you're acquiring or refinancing, but they'll allow an offset on any properties you already own. Now, in an offset, what ends up happening is they use up to 80% of the income to offset all of the expenses on the property. And whatever is left over is a liability or an income. So if you had $1,000 a month in rent and they're using the 80% offset, in theory, if the $800 a month in rent covered all of the expenses, then there'd be no net effect on your debt servicing and you'd be able to continually buy property after property. So the offset, as you can see here, even though the number is not that far off, it's 50% versus 80%, there's a massive difference in the amount of income actually used. It's $200 versus $800. It's a really big difference. Now, there is one third option that some lenders will use on the residential financing, and it's called DCR. It stands for debt coverage ratio. And this method is typically used for commercial lending. So what a DCR is they usually like to see that the property that you're financing and the overall portfolio have an income to debt ratio of about 1.1 or 1.2. So that means that the amount of credit and debt they're going to give you, they would ensure that the income is 1.1 or 1.2 times all of the expenses, like the property taxes, strata fees, and the mortgage payments. So if you're buying a property that has $1,100 a month in rent, and the expenses are $300 a month, then you would lend to you where the mortgage payments do not exceed $700 a month, because it would be $300 plus $700 in expenses, $1,000 in expenses, and $1,100 in revenue. That would be a 1.1 to 1 ratio of income to debt. So the way that they look at this is that they use all the income, but there must be a surplus in order to qualify. So this is how lenders actually treat rental properties on the commercial side. So if you're buying a apartment building, or if you're buying an industrial property, strip mall, something like that, then typically lenders are using a DCR, a debt coverage ratio. And usually on the debt coverage ratio on the commercial side, they're usually using a larger amount. And so that's something that they're typically trying to look at. Usually about a 1.25 to 1 ratio of income to debt. Okay. Let's see here. I think there's a question just about whether this is being recorded, and yes, it is being recorded, and it is live, by the way. I am live. This is not pre-recorded. I will answer any Q&A questions and whatnot after we're finished, by the way. So let's talk about the second property. So let's buy a property now that has that's $500,000 and generates $2,500 a month in rent. What you could do is you could then convert your existing residence into a rental. And so let's just assume that it's now generating $2,500 a month in rent. And now you're buying a residence for $500,000 with 5% down. Now the income requirement is now jumping up. So now instead of needing about $125,000 of income, you probably need 155 to 185 in income now. So your income requirements are starting to jump up. And this is where, for some individuals, it's a bit harder for you to qualify when you're just putting the 5% down, because you have, unfortunately, you just have more debt. Now, on the other side of things, on a rental property with 20% down, depending on the amount of income required, because lenders are using less rental income on the property itself that you're financing, you might actually find that you need a similar amount of income in order to qualify. But regardless, that income level is still increasing. So you're starting to get into the $150,000 or $185,000 income levels in order to buy that property. When you're buying your third, it's a bit of a stretch now. It'll be a little bit more difficult for you to buy a third. If you already have two properties and buying a residence as your third, it is possible. However, if you got the first two properties that you bought were both insured mortgages, it is very difficult to get the insurer to do a third one. Usually they like to do two max. But the income level that you need is starting to definitely increase at this point. If you're buying a rental property, your income level is starting to increase, and it really depends. And in some cases, even that $200,000 income needed could be much higher, depending on what policies the lenders use. So I try to pick lenders that are reasonable on their rental income policy here in order to be looking at how much income you need to qualify to continue to buy rental properties in real estate. Now, there's a couple of key points I want to talk about on properties number 2 and 3. And one of the first ones is which lenders to use. Different lenders use different amounts of rental income, and certain lenders are good for your first couple of rentals and certain lenders are not. There's a host of different reasons for that. The qualifications is one of them. And also trying to figure out if some lenders will not lend to you on 5 or more properties. And so usually there's not a lot of lenders that will lend to you if you have over 5. It's good to preserve those lenders for later instead of using them up and filling them up early and having too much debt with them so that they don't want to finance you when you have over 5. This is where it's helpful to use other lenders that are not good for you when you have over 5 anyways. And so you're not really sawing off one option that you would have when you're getting into the later stages of building your portfolio. One thing that's also important too is that when you're buying your home, a lot of people are conditioned to be looking purely at what the best interest rate is, and so that's something that that people usually, when you buy your first home, that's what you're looking for. I just want the best rate because that's the most important thing at that time. What will end up happening over your investing career is that eventually the leverage aspect becomes more important than the interest rate. You know, if you look at getting 0.1 or 0.2% better of an interest rate, but needing to put maybe the down payment is 35% down instead of 20% down, that will have a much larger impact on your overall return on investment to have to put 35% down instead of trying to put just 20% down. And so that's one of the things that you want to watch for. And often when you're buying your first rental property, even, you still may have a lot of options and you can shop the market. But in general, if you're faced with the difference between having to put more or less down payment and looking at a lower interest rate versus a higher interest rate, in general, putting less down payment, even if the rate is a little bit higher, usually makes more financial sense. Your overall return on investment will be better that way. Another key thing is buying strong cash flow properties. You buy a lot of speculative properties that do not generate great cash flow. Every rental property that you own will generally be a net negative on your application. So I'll repeat that every rental property you own will generally be a net negative on your application. And that's because the lenders only use between 50 to 80% of the rent to help you qualify. And so it's really important that you buy properties that generate really strong cash flow. And one other thing that I wanted to mention is that you don't want to fall into the analysis paralysis trap. And what I mean by that is that sometimes people start looking and they want to buy the first rental or second rental, and they just sit there and they don't do anything. They overanalyze every single deal. They're trying to think of, oh, what should I do? What should I do? Should I buy this one or should I buy that one? If you get good at just being able to speed up the process of determining whether a deal is a good deal or not, and I will get to that later in the presentation on some tips and tricks on how to do that. In general, it's worth being able to pull the trigger when you can get a good deal instead of trying to overanalyze the market and especially trying to time it. It's very, very difficult to time the real estate market. And Tara, yes, this will be recorded, and then we'll be emailing it to everybody that registered. So we'll be emailing the copy of the presentation out. So step 4, now we're trying to get into properties number 4 and 5. So now we're in a situation where, you know, some of us are feeling good. Now we've got 2 rental properties, we've got our own home. Well, just wait until you've been declined by your bank. And so let's talk a little bit about hitting that wall. Things get to be a lot trickier, and usually, the first rental property or 2, if you have good income, might not be that difficult. But a lot of people start to hit that wall, and there's a lot of reasons that you could hit that wall. The first reason is, well, a residence buying with 5% down is pretty much off the table at this point. Be very difficult to get the mortgage insured to buy that story. And in general, it's just very difficult for you to qualify. And now if you're getting into buying rentals with 20% down, given these, properties where they're $500,000 purchase price and $2,500 a month in rent, you're probably needing $180,000 to $250,000 of income, maybe even more with some lenders that don't use a lot of rental income. So it's starting to get quite income heavy. And this is one of the biggest challenges that you're going to start to face. Now, a couple of the key points for you at this stage is that keep in mind that the lender guidelines vary and they stack with more properties. So what I mean by this is that if a lender only uses 50% of the rent and you now have 4 properties. Well, that's 4 losses that you have to be able to debt service on your application now. So if you're having 4 properties that are showing an $800 loss according to the lender, well, that's $3,200 that you have to now carry on your as a liability, which is a pretty significant amount. In fact, you probably need about an $80,000 income just to service the shortfall on your rental properties that to you might actually be cash flow neutral, but to the bank, they may be cash flow negative. So this is where things get a bit more difficult. Also, the lender guidelines are very, very difficult too. So different lenders that use less rental income or more rental income, you're going to find that the lenders that use less rental income, it becomes harder and harder as the portfolio grows to keep qualifying with them. Whereas lenders that use a lot of rental income, it can be a lot easier. Not to mention that the lender policies change all the time. I've been a broker for almost 17 years now, and it just seems like it's a never-ending thing where they always change policies and it becomes more difficult. Now, what ends up happening too is a couple of lenders, when you're at the 4 to 5 stage, start to use this DCR method, this debt coverage ratio method. So it is even more important that all of the properties in your portfolio are covering themselves, and ideally covering themselves, but at a positive, putting a little bit of money back in your pocket. One other thing that's important at this stage is that the liquid assets are put under the magnifying glass. So there isn't yet usually a strict rule of thumb, although a couple of lenders do have some policies on this. As a general rule of thumb, it's good to have about $30,000 to $50,000 in liquid assets per property. Some lenders look at a target of about 10% of the asset value in liquid assets, which often is more than most people have, especially in British Columbia. And there are some lenders that have a more strict rule where you have to have at least $100,000 in liquid assets when you hit your 3rd rental property. So there's a couple of little new nuances here that you do need to keep in mind, especially when you're looking at trying to qualify. And it is important for you to have liquidity, especially in this kind of market. We just saw interest rates rise so aggressively during 2022, and even today, Bank of Canada went up 1.25%. So in a climate like this, it's important for you to have some liquidity, making sure that you have some money set aside in other investments to weather any storm that might happen. And that's the way that banks look at it too. The other thing you want to keep in mind is that many lenders do have the 5 max rule. So most lenders will only lend to a customer and will only give you maximum 5 mortgages on the residential side. Or if they'll go up to more than 5, then it's usually up to about 10, as long as no more than 5 are with them. So just keep that in mind, and it does get trickier when you start getting into the 5+ category. And if you're at properties 4 and 5, then you're gonna be starting to get there. My next webinar, by the way, which is going to be in July, we'll be talking about buying 5+ properties. So we'll be talking a little bit more about the different strategies that people use when they're buying 5+, because in general, those strategies tend to be a little bit different and a little bit more complicated than buying your first 5. Buying your first 5 is easy compared to buying your 6 to 10 properties. So a quick summary of some of the things we talked about. I talked a lot about debt servicing, and that's because that's the primary way that lenders determine whether you qualify or not. If you don't debt service, it doesn't matter if you have a really good income or very good credit, et cetera. They're really looking at your ability to service this debt. And so that's where we're always trying to shop around and figure out which lenders' policies do we best fit with to help you service that debt. And so it's all about cash flow. And that means that buying properties that cash flow positive is really, really important. And it also means that taking a 30-year amortization is really important to make sure that you have a low payment on all of your rental properties to make it a lot easier. Of course, eliminating all other high interest debt. A car loan, for instance, with $25,000 owing and a $550 a month payment is about the same as borrowing $100,000 in a mortgage. So a lot of the time, if you do a refinance and roll up that debt and place it into the mortgage, you could probably pay off that car loan and only increase your mortgage payments by maybe $125 or $150 a month, which is much lower than the $550 a month that you're paying for the car. So this is often one of the first things we do is do a debt consolidation if there are other debts, which will improve your borrowing power. If you don't already have a HELOC, then that's usually step number 1 if you already own your own home. If you don't already own your own home, then making sure you buy your home first is generally the first thing to do. And it's really important to follow the game plan. If you fail to plan, you plan to fail. Not my phrase. I did steal it because I think it's really, really good. But it's important to make sure that you set up a game plan and you work on executing that game plan. Last thing I want to mention here in the summary is it's important to surround yourself with people that are experts in investing in real estate. That means accountants, that means realtors, mortgage brokers, etc. This is a very specialized field. There's a lot of little nuances, a lot of tax nuances. There's a lot of qualification nuances. Buying the right type of property. If you're using a realtor that says, hey, this property is really good because it's across the street from the school and it has a really nice walk-in closet. Well, does that really mean that the numbers are good on that property? Is it a good investment property? It might be good for a family, somebody that has young kids that would be going to school. But it's important to make sure you have somebody on your team that understands what investors are looking for. And there is a bit of a difference. So make sure that when you're creating a game plan, the game plans can vary from person to person. And a game plan for 5+ properties is very different than somebody that just wants to buy one property. It's a lot more complicated, a lot more challenging, and there's a lot of little nuances. And I know that overall, when you first get into investing in real estate, a lot of this can be very, very daunting. And so we do want to try to make it easy for you and make it simple and kind of give you a high level of what are the things that you want to do, and that's where we can help. So who wants to invest in real estate? You guys want to make some money or what? Let's get going. So I guess the question is, well, why don't more people invest in real estate? It's complicated. That's really what it comes down to. Lack of education, lack of comfort, lack of confidence in knowing what to do and how to do it. So some of the tips and tricks that I have to give you the confidence you need is helping you with the deal analysis part, okay? So some things that you want to look at here, I like to use shortcuts. Shortcuts are great. So one of the things I look at here is the rent to price ratio. So if I look at a property that's worth $500,000 and I'm trying to figure out what kind of income I would need to likely make this deal work, in general, I'm looking for at least a 0.4% rent to price ratio to be about break even with 20% down. Now, I will say where rates are today, it is harder to find that deals will cash flow using a 0.4% rent to price ratio. And the reason for that is my next point, which is that 100K generally equals about $400 a month. That's not actually true in today's climate. 100 grand is probably closer to 550 in today's climate. And so it is more expensive. That being said, I think it's important to look at, what is the long-term impact and long-term effect likely going to be? It's probably somewhere in between. You can probably expect that long-term, 100 grand will cost you $475 or maybe $500 a month on the mortgage payments. And so if you're doing a deal analysis and trying to figure out, what might be a good point here, what makes sense on what kind of price should I be paying for it, that's something I look at. Another thing too is if you're looking at a basement suite, a house that has a basement suite that's that is going to cost you $100,000 more. Well, I know that if a basement suite rents out for $1,200 a month, my cost of borrowing the 100 grand will only be about $500 more a month. Then I know that my personal budget will be much better to buy the home that has the basement suite in it. Using tools, of course, is really important. We do have a cash flow analysis spreadsheet. So that is a spreadsheet. I'll show you a picture of it in the next slide, I think it is. And it's just a quick breakdown of what's the purchase price, down payment amount, what's the interest rate, what are the expenses and income, and it'll calculate your cash flow, your cash on cash return, your overall return on investment, et cetera. So it's a really good tool to utilize to help you figure out whether a deal is a good deal or not and to compare properties A or B. Now, on the topic of rent, I really like rentometer.com. Craigslist and Kijiji are other options to determine the rents, but I find that it's a bit more specific. So you're then having to go to Craigslist and click on it. Is this one better than mine or not as good as mine? It takes a little bit longer to assess what the market rents are. I really like Rentometer, and the reason I like Rentometer is that it gives you the 25th, 50th, and 75th percentiles. And so if I know I'm buying a brand new property, I'm probably going to be in the 75th percentile for rents. If I'm buying a dump that needs a lot of work, then I might be in the 25th percentile. So you get to put in the address, the number of bedrooms the property is, and it'll give you a bunch of macro data and it'll give you the comparable rental properties in the area, which is really key. So I really do like Rental Meter quite a bit. And then the other thing that I like to look at is using specific metrics to compare the return on investment. And so I want to filter things really quickly. As an example, what I might do is I might say, well, I expect the Edmonton market might not appreciate at the same rate as something in British Columbia. So for me, in my spreadsheet, then I would often just say, well, to downplay that, I'm going to assign a 2% annual appreciation rate to Edmonton, and I'll assign a 3% annual appreciation rate to British Columbia. And that's how I'm going to balance that out and make sure that fits and that works. And that way I can kind of understand what my overall return on investment might be. Because Edmonton might have a better cash flow than a British Columbia property, but I also want to factor in an expected appreciation rate. And another thing you might find is that you want to quickly gain an understanding of a market. And this is where you might find that in certain markets, different property types might perform better. In Vancouver, a house is going to be very difficult to cash flow. So you might find that a downtown, fully furnished, medium-term rental property in Vancouver might be the best option. I'm not saying it is, but it could be. But maybe if you go to Edmonton, maybe duplexes and fourplexes end up becoming a better option for you than a condo would, because you find that the numbers work. So once you start to filter that out and you observe in a different market that, oh, it seems like a lot of the duplexes and fourplexes seem to generate better numbers from an ROI, then you can focus your efforts on mostly those instead of looking at every single deal to see what is a deal and what is not a deal. So this is just a quick snapshot of what the spreadsheet looks like. It's obviously cut off a little bit at the bottom. I didn't have enough space to throw on the whole thing, but it's a useful tool, and you can always email us to get a copy of this tool so you can do your own analysis on potential real estate acquisitions. Now, one thing I do want to talk about a little bit is that the money is starting to dry up a little bit, and it is getting harder to qualify. And there's some talk about the minimum down payment increasing. Now, if the minimum down payment increases, this is not good news for your return on investment. If you have to put more money down on the property, that means that your return on investment will decrease because now you have more money in the property making you the same kind of return. And so in general, this is not good news. We haven't heard official word about them increasing the down payment for rental properties, but there is a possibility that we might be seeing some changes coming where it could be getting more difficult for you to get an approval and get financing from a bank, especially if you're trying to buy an investment property. So given all of this, what are our clients doing? Definitely reducing their payments and paying off high interest debts by refinancing. If you're not going to do anything else, then this is a really important point, especially in an environment where interest rates are where they are. Making sure that you reduce your payments and your high interest debt by paying off those debts is really important. Also learning how the Smith maneuver works and can help people save thousands in tax. It's a really simple, it can be a really simple change for you. Definitely something that I recommend that you look into if you haven't already. And getting access to capital to invest and try to earn a spread on the interest cost versus the return. Now, obviously, with mortgage rates continuing to climb as they have throughout 2022 and for the first bit of 2023, it is harder to borrow money and then invest it and create a spread on that return. But a lot of people, especially if your mortgage is coming up for renewal, it's a really good time to get access to not only just a mortgage and a good mortgage rate, but then getting access to additional capital available on your line of credit too. And the last thing I want to mention here is a lot of our clients are starting to get back into utilizing their home equity to buy rental properties or to just invest in something in real estate. A lot of our clients are also doing private lending too. Private lending rates are anywhere between 9 to 12%, depending on the situation and circumstance. And so you can borrow against your line of credit to then invest and just create a spread on the cost of borrowing versus your investment return. So something to consider. Now, all of this that we've talked about doesn't mean anything unless you actually turn this knowledge into action. And so, more important than any of this information is just to start to get out there and, start to write offers on properties, even if you're writing low bids, just to see what sticks. It's not a bad idea to be getting out there and trying to turn this knowledge into action. If you do need some help with helping build your real estate portfolio, you can of course book a consult with us. Don't forget to take us up on the offer of getting a free copy of the Smith maneuver. I think I have about 10 in the office. So the first 10 people that email us, we can happily send a copy of that book in the mail. And who could forget, I am also a best-selling author. I wrote Rockstar Real Estate Investing, and that book, if you do not have it, is a great book for teaching you about the fundamentals of investing in real estate, how to start off, what are the numbers, doing an analysis, looking at flipping homes, buying cash flow properties, etc. So great book if you're looking at starting off, and or if you're looking at, you've got 1 or 2 rental properties, you're just looking for some foundational knowledge. So again, happy to send a copy of that book in the mail too, if you're looking for a copy. And this is how you can contact us. You can email us at info@greenmortgageteam.ca. You can call us. By the way, the PIN is not the correct PIN. We actually moved from that office. We're at Granville Street, which is Granville and 10th. So thank you so much. Thanks for attending. I will now go into the Q&A and start to answer some of those questions that we've had here. Okay, so John asked, what is the impact to the new foreign owner tax where 2 or more rentals, we're owning 2 or more rentals jointly with spouse or corporately? So it depends. I'm not sure which specific tax you're referencing here, John, on the foreign owner tax. Maybe you can give me some clarity on what tax specifically you're talking about. If it's the empty home tax or it's the speculation tax, there's so many taxes that need to be a bit more specific on that. But yeah, just let me know and then we can address that. Laura asking if this is being recorded. Yes, it is recorded. I will be sending out the recording to everybody that registered for the event, so registered and attendees. Yuri, hey Yuri, you mentioned that the car loan would be could be consolidated for the mortgage. Will it be possible for a new car purchase? So you can do that. You can refinance a home to then use to buy a car. Also, if you get a mortgage and a line of credit, then you can utilize the line of credit to borrow some extra funds to purchase the car outright. But it is stemming from restructuring the mortgage itself instead of it stemming from the car financing itself. In general, we do recommend that you make sure you understand what the implications would be if you were to buy a car, what the car payments would be, and how much of an impact that would have on your borrowing power. And yeah, if your renewal is coming up, and you want to buy a car as well, it would make sense. I mean, car loans. I was looking at this and talking to a dealership the other day, and I think they're at 9.5% interest for car loans. So it's quite a bit more expensive than it used to be. It's something that you definitely want to consider. And of course, a mortgage is generally much cheaper debt, and especially on the payments. All right, so that was all the Q&A. I'll go into the chat and just see if there's anything else that came up here. Oh, it's smoky in Ottawa too. Geez. Okay. Yeah, smoky in Langley as well. That's for sure. I know there's quite a bit going on. And I think there's also fire on Vancouver Island near Port Alberni. So yeah, lots of fires. Question from Janet: how can we ensure positive cash flow other than the obvious down payment amount? Amortization, so 30-year amortization on all of the debt. And then of course the term selection. So depending on the term that you choose, I will say that in general, it is difficult to choose the right term. This is a weird climate where long-term fixed rates are lower than the short-term fixed rates. However, we've done a couple of break-even analysis on where rates would have to be in the next couple of years for you to be better off taking a longer-term fixed versus a shorter-term fixed. And based off of most of the economists' predictions on where rates will be in 2 or 3 years, it seems like the 2-year or the 3-year fixed rate tend to offer the best value, perhaps even the 1-year rate. Until the Bank of Canada increased rates this morning, there were some assumptions that if you took a certain assumption, a variable rate would outperform a fixed rate over the next 3 years as well. And we are going to have to redo our analysis based off of the Bank of Canada increasing today. And we're not really sure what they're going to do for the rest of the year either. Initially, it sounded like they were likely to stay quite flat throughout the year and maybe start to decrease starting in January of next year. Now we're really not sure. This information will change every 3 or 4 weeks, by the way. It wasn't too long ago, 3 or 4 weeks ago, that general consensus is that the lenders aren't, or the Bank of Canada is not increasing rates during the year. And all of a sudden they're increasing it, and they might increase it again is the signaling that we're hearing. I'd be a bit surprised that they increased it again, but who knows? I was surprised that they increased it this morning too. So it's just really hard to predict. David asked, can you explain how people get 50-year mortgages with commercial properties? Yeah, great question. So I've explained this and talked about this a little bit in some of my commercial financing webinars. You can get, if you buy a 5+ unit residential property, so that's 5 or more units on one title, that can be financed through CMHC on the commercial side. And you can get up to 50-year amortizations and up to 95% financing with CMHC if you hit certain parameters and guidelines. There's a number of different guidelines that you need to hit that are related to affordability, accessibility, and energy efficiency. And so if you're able to hit some of those targets, you can get up to a 50-year amortization. So it's very, very unique. Different sandbox altogether. You have to have generally more cash, and the qualifications are reliant more on the property itself as opposed to you as the borrower. So different game plan, but a lot of our clients are starting to look at the insured multifamily properties to go through CMHC right now. Cam asked the question, can you get additional second personal residence to 5% down even if you already own a rental? And do you pay the capital gains on the second primary once sold? The question is, can you get an additional second personal residence at 5% down? Yes, you can. You can buy a second home with those 5% down. That's definitely something that's possible. We do that all the time. Most commonly, of course, is somebody owns a home and then they buy a cabin or they buy a second home for immediate family to live in. So, I need to take care of my parents, and so they're going to move closer to me and I'm going to buy a property for them to live in. The difference is a second home, you don't use income to help qualify. So that's something that is considered. And in general, Cam, my understanding with the taxes is that you usually assign one property that you do not pay capital gains on. So I don't believe, and you'd have to check with your accountant on this, but I do not believe that you'd be able to claim the capital gains exemption on both your residence and a secondary property. Although I could be mistaken on that one. Something you should check with the accountant. Other than that, I have a question from Shuan. Hey, Shuan. What if our income stays the same or drops? We want to buy a third, fourth, fifth property. Do we now move to B lenders or commercial lenders? Yeah, good point. So if your income drops over time, then it will become more difficult. So not only do you have more properties that have to have higher income to debt service, but if your income's also dropping, then you really need to lean on lenders that use a high percentage of rental income. So in general, I view it as a bit of a pyramid where as you go higher up on the purchase price range, there's less and less options available to you. This is something that you need to consider as you're building your real estate portfolio. It does become more and more difficult as your portfolio increases. So you may have to move to B lenders, or sometimes what people will do is they'll move into commercial lending, especially if they expect their income to start to decrease, but they have a larger net worth. Sometimes they'll sell off a few of the residences or residential rentals, and then they'll buy one apartment building and they'll invest in that and buy a 10-unit building or something like that, where the qualifications are reliant more on the rental, the commercial property itself instead of on your personal income. So that is a common strategy. The new federal tax. John, I'm not super familiar with all the nuances and how it would impact if you have a second property. Actually, it's not something I've dove into. I've actually asked my accountant to give me some clarity on that, and they're looking into it to kind of wrap their head around it. So I can't really speak to that at this time. I don't have enough detail to do so, but it is something we should definitely get some feedback from an accountant about. Ben, as a quick question, how would you find a list of banks or lenders that offer 80% rental income instead of 50%? Well, Ben, you got to talk to the right mortgage broker, of course. Honestly, this information changes all the time, Ben. We have internally for my own team, we keep an updated policy manual that retains and tracks what every lender's policies are at any given time. And we find that this helps us quite a bit with assessing where a client can fit and how we can qualify them to get a mortgage. This is something that is really important to know, that the policies just change all the time. So even if I gave you a list today, it's going to change. I will say this: in general, right now, the credit unions are using more rental income to qualify than most of the major banks are. But on the flip side, the major banks are extending their debt service ratio. Instead of only using 44% of your income to use towards all of your debts, they might be using 48%. So even if they're using less rent, but they're using a higher overall percentage of all of the income sources, then in some cases, it even works better with a bank that uses less rental income. So it's quite confusing. This is where, as a mortgage broker, our job is to go in and assess where our client can fit and re-underwrite the deal to see what options we have for our client. So it's, there's a lot to do there. Q&A. So David asked, have we started seeing more foreclosures? I haven't observed that. The default rates that are being reported by most of the banks are still quite low. A very, very minor tick up, but nothing too crazy. So it'd be interesting to see what happens. Interestingly, if you look the concern here is that a lot of clients are coming up for renewal now. So of course you have people in variable rate mortgages, but you also have people that took a mortgage 5 years ago. But 5 years ago, we were also in a rate situation where the rates had kind of peaked and then started to fall. Now the peak was not nearly as high as what peak we're in right now. But back in 2018, interest rates were around 3.5% to even as high as 4% for quite some time. I think they were on the low end in the spring, we're closer to 3.29% or so. Now, given that, that's a much smaller swing up. So about a 2% increase to the interest rates when they come up for renewal, but it's not as high as like a 4% increase for those that took 5-year fixed rate mortgages back in 2021 at 1.69%. It's not nearly as drastic or dire of a situation. Sherry asks, if you use your HELOC for the 20% down payment, do you still need to requalify for a mortgage to lock in a rate? So no. So on the HELOC, if you just borrowed the 20% down on the line of credit and then you locked in that 20% you borrowed into a mortgage, you can call the bank that has that HELOC and you can ask them to lock it in. You do not need to requalify because they've already approved you for that credit. But when you go to buy the other rental property, you will need to qualify for that mortgage. So just borrowing against your line of credit and or locking in some of that line of credit into a mortgage term does not result in you having to requalify. But when you go out and obtain new credit or more credit, then that's where you would have to requalify. So John's mentioning the CFIB was to have a seminar this week with regards to the new federal foreign owners tax reporting. Okay. Yeah, it's something I think that we all need to be a little bit more familiar with. I mean, a lot of my clients aren't foreign owners, and so it doesn't apply to a lot of our clients. But I think that some people could be classified as that even just by moving out of Canada. So it's very interesting. Eric asks, is Scotia one of the lenders that will lend over 5 properties? So Scotia is one of the lenders that can consider over 5 properties, but not if you've borrowed and if you have more than 5 mortgages with them. So no more than 5 with them, and they are difficult to get over 5. By the way, it's not easy. Technically, it's 5 rentals and 1 residence, but they typically will not lend to you if you have more than 5 mortgages with them. Dennis asks, what's the longest amortization available for residential mortgages? That will be a 30-year amortization for regular residential A lender mortgages. There are some B lenders that go up to 40-year amortizations, but the reality is that because you're paying a higher interest rate and you're getting a 40-year amortization, the 40-year amortization is usually best suited for those borrowers that can't qualify for A lending, and the 40-year amortization just helps keep the payments closer to the 30-year amortization payments, and so it's not really a great option. David asked, what's considered a commercial mortgage more than 5 units? Yeah, you got it. So basically 4 or less residential units is residential. Everything else is considered commercial. So the strip mall, industrial, 5+ residential units, those are all considered commercial mortgages, and they're treated differently. Richard asks, are there any mortgage options for retired people that have little or no employment income? Yes, there are actually. So there are some net worth programs that exist where if you have a lot of equity in your home and or you have a lot of liquid net worth in investments, there are some programs where lenders will lend to you based off of your net worth and lean on that. The easiest way to look at it is most lenders have a program that's kind of like this, where if your income would qualify for only $200,000, we have an additional eligible $500,000 in eligible assets then they could lend to you up to $700,000. So you might be able to qualify for a much larger amount if you were to do that. So something to keep in mind is those net worth programs do help. David asks, how many properties do I own? Ooh, nice question. Okay, so I own 1, 2, 3, 4. I have 13 properties today. So 7 units are in one building in downtown Victoria. And then I own 5 properties up in northern BC. And then I own my residence. So 13, yeah. Thanks for putting me on the spot there, David. Let's see here. Cherry, would it be more difficult to qualify using an incorporation? In general, yes. It's a little bit harder to qualify using a corp. In general, there's less lenders that lend to corps. And on top of that, a lot of the time they charge slightly higher interest rates, or they might have more limitations to the type of lending that they will do. So yes, it's a little bit harder to get financing in a corporation, but not impossible. It's definitely easy in some regards, but it depends on the lender. And in general, it just means that you don't have as many options. You can't shop as many lenders because many lenders do not lend to a corporate name. Joyce has a question. I had a HELOC on my rental property, but found the interest rates being so high, I was paying over $700 a month just for interest. How to justify getting a HELOC? This is on top of the negative cash flow of my rental properties. So Joyce, one of the things to look at there would be to consider locking in the money that's on your line of credit into a mortgage term. Now, right now, we're in a weird spot where the variable rates are actually much higher than fixed rates. We don't always see that. A lot of the time, the prime rate is a lot closer to where fixed rates are. But right now, the prime rate is up at 6.95%, and a lot of fixed rate mortgages are in the mid 5s. And so by the time you add on that extra, usually a line of credit is prime plus 0.5%. So you're paying, close to 7.5 now on that line of credit. If you're to lock that into a mortgage term, like a 3-year fixed rate or something like that, you'd be dropping the rate down to about 5.5%. So that could be a good option for you to lower your overall interest cost for sure. Tara, you're asking how to make an appointment with me. My email is kyle@greenmortgageteam.ca. So if you email me, then we can set up a time to chat. Raj, I remember some years ago that you had a down payment of at least 35% down. You could still qualify for the mortgage without the confirmation of income for your personal home. Can it help to borrow by switching a personal home into a rental to put 35% down towards your second house? Sorry, it's super specific. Okay, so there are some programs that with 35% down, it can be easier to qualify. It's not nearly as easy as what I'm thinking you're referencing. There used to be a time, and this is over 10 years ago now, where if you had 35% down buying your own home, it was almost just a slam dunk done deal. There's no questions asked. No longer do those programs exist, but there are some net worth programs, some corporate income programs, the different programs available with 35% down, but a lot of them do require the property to be your residence and not a rental, which means you'd have to be turning your existing into a rental and then buying a residence. So to a certain extent, yes, that is something that you could look at. But yes, it is more challenging. It's not as easy as just being an absolute slam dunk. That's 35% down is no questions asked. Awesome. John, I've spoken to an accountant with regards to the 2 or more rental properties owned jointly. To be clarified, as the federal government has created a mess. Yes, I agree. Reporting must be submitted April 1st with significant penalties. And they're supposed to have a webinar yesterday. I'm wondering if you're thinking about the Land Transparency Act, the LOT, I think it's LOTR, Land Owner Title Registry, I think it is. But I think this might be something that's slightly different. But there was something that, yes, it was deferred. So that might be the thing you're referencing. So David is asking, are you supposed to report it if you have 2 more or more rentals? I'm not sure if you're referencing John's item there, but I'll mention this. If you do have rental income, you should be reporting it on your tax returns because a lot of lenders will not use rental income unless it's on your tax returns. Ross has the question, for a case where you have a larger deposit without enough income to borrow in the past 2 years. Yeah, so just as you or I had mentioned, sometimes there are programs with 35% down where you might be able to qualify in certain cases, but it's not just a no questions asked type of arrangement. You still have to be able to fit into a specific box, and usually that's something where you have corporate income or you have a net worth, a large liquid net worth. Aid asks, how does an assumable mortgage work? Okay, so if I own a property and have a mortgage on it and it's a really good rate, and you're buying my home, then you could assume my mortgage, and then so you could actually apply to the bank that I have my mortgage to apply to take over and assume my mortgage, and you could take that over. So that is an option that you could look into. In many cases, then you cannot change the terms of the assumable mortgage. So you have to take it over, and you're taking over at the same term remaining and a number of other things. So that's something you'd have to take a look at. David asked, can you lock a HELOC mortgage? Yes, so you can lock in the line of credit into a term inside of the HELOC, and then you pay mortgage rate instead of a line of credit rate. Line of credit is interest only, which is nice, but at a higher interest rate. And then a mortgage is amortized over 30 years, but is a lower rate. And normally we used to find that the payments on an amortized mortgage would be higher than the interest only, but now it's actually about the same, but you're paying way less in interest. And on $100,000, let's say that you'd be locking in, if you're paying 7.5 on the line of credit or 5.5 on the mortgage, well, that's $2,000 a year in interest. It's pretty significant. Jacob asks, will I be at the brunch this Sunday? And yes, I will. I'm speaking at the brunch, so I will see you on Sunday. See you there, Jacob. Roshan asks, can you do a second mortgage on the same house, keeping the original mortgage rate and getting a new rate for the new amount? So yes, you can with the same lender. It just depends on the lender. But usually you'd have to go back to the same bank. Usually lenders don't like to go behind each other. So if a Scotiabank mortgage, TD probably won't want to do a second mortgage behind Scotia. So normally you're going back to the same bank to try and get them to add on another term or another portion behind it. So it really depends on which lender you're referencing. And then Devin asked a question: portable mortgages require requirements typically. So on the portable mortgage side of things, a portable mortgage means that if I sell my property and then I'm buying a new property, I can port my mortgage and take it with me. The requirements for this generally is that you usually have to port it within, depending on the lender. Some of them need the exact same day where you're selling and buying and it's closing on the same day. But most lenders allow you to port it as long as you close within 30 or 60 days. So let's say that that you sold your home and you closed on July 1st. And you don't own or purchase the new home until August 1st or September 1st, then you may be able to port your mortgage in that kind of case. Now, if you're doing the opposite, buying before you sell, then you cannot port it because you have to get a mortgage on the new purchase. And a port is typically only used when you're actually selling and then buying the new property. So a port allows you to not have to pay a penalty. If you sell the property before you buy the new one, or even if it's concurrent, sometimes what happens is you pay the penalty and then they refund you once the new mortgage is back in effect. And that's how most lenders do that on a port. So just something to keep in mind. But a port is nice, especially if you have a good fixed rate mortgage. Try asks, if you lock in the HELOC into a mortgage, but you were using the Smith maneuver that disqualify the interest. So as long as you have a paper trail showing you that the money that you borrowed was used for investment purposes, then you should be okay. It does not need to be sitting on the line of credit to be considered tax deductible. It just needs you to be able to show and exemplify that you borrowed the money to invest. And so even locking it into a mortgage term does not disqualify or should not disqualify it from being tax deductible. Okay, I think I've answered all of your questions. Any other questions, everyone? Oh, here we go. Can you buy a property in cash, then port the mortgage? Very case by case, Devin. A lot of banks will say no, they will not allow you to do that. You have to be buying the new home for you to be able to be eligible to port. But I have, on very rare occasions, seen a bank make an exception for that. So it's very case by case. If you're thinking about this, then you really should talk to your bank and see if they would be willing and able to do a port if you're doing something a bit more unconventional. Let's put it that way. Yeah. Awesome. Well, it looks like everyone's all of your questions are answered, which is great. Thanks so much for coming out. I really appreciate seeing all of you. I will see some of you on Sunday. If you're not going to be there, then that's fine. But look forward to seeing many of you in the future. So thanks so much. Have a great night, and we'll see you next month.